Hello, chart watchers, and welcome to this Tuesday, October 16th Market Watchers Live Show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we got a really nice day going so far in the U.S. market. We got the Dow Jones Industrial Average currently up 375 points. The S&P 500 up 42. The Nasdaq up 149 points, and the Russell 2000 going along for the ride, up 24 points. 10-year Treasury yield relatively flat, sticking around that 3.16% level. Volatility index up at 29 just a few days ago. Now back down in the teens at 18.5 roughly, down nearly 3 points today. So pretty big drop there in volatility, which we would expect with the market doing as well as it is. Leadership has returned to some of the more aggressive areas in the market. You can see technology up nearly 2.5% today. Healthcare also having a very strong day. This has been one of the leaders over the past few months, and healthcare looking to strengthen here as well. Software getting a big boost today. This is a group that had been a market leader all the way to the beginning of October, went through a pretty significant swoon to the downside. Adobe gave the group a big lift today. They raised their revenue forecast for fiscal year 2019, and that is not only lifting Adobe up quite significantly, but also lifting the entire group. Industrial suppliers, though, taking it on the chin to the downside as W.W. Grainger broke its four-quarter winning streak of reporting earnings and moving higher, this time actually moving lower. And we talked about this one, I think, on 10 and 10, one of the segments here recently. And it did look like with negative divergence, we had room to the downside. Their revenues came up just a tad short. Market was not expecting it, and Grainger getting hit hard to the downside. Okay, Erin, well, earnings season beginning to kick in. It's hard to believe we're into another earnings season, but this is literally when a lot of the big companies, the large cap companies, start to report. Then we'll get some bigger technology names and so forth in another week or two. But looks like this volatility is here to stay with us for a little while.
It does indeed. Yeah, it did pull back so far today. But yeah, like you said, I mean, it is an up day. So everybody's feeling a little better than they did yesterday and the day before that. So yeah, it'll be interesting to see how earnings come in, if they're going to be mixed, or what are you expecting?
I think earnings are going to be strong. And I think this morning kind of bears that out. But that doesn't always translate into a higher market. And so with all the volatility that we've seen of late, I think there's plenty of fear to go around. And some of the companies like W.W. Grainger, they came up just a little bit short on their revenues, but they blew the bottom line out again. And it didn't seem to matter. So I think the market's priced in a lot of good stuff. And even though we'll get good earnings, I think the key is going to be how the market reacts to it.
Yes, absolutely. Should be exciting. I know you always get very excited, you and John Hopkins, about earnings season. So should be a good one.
Yeah, I trade these earnings gaps. So this is kind of the season where I'm putting a lot of the charts together in my chart list. So it's not just the reporting, whether the good earnings are good or bad, but also how the market treats those companies after their reports. So a lot to look at here over the next few weeks for sure.
Absolutely. All right, well, our upcoming schedule for this week, I guess you could say, we have Barton Bring coming in tomorrow. Can't wait to talk to him. It's been a while. I'm trying to think if he was on the show. Julius de Kempener will be joining us Thursday, and Mary Ellen McGonigal will be back on Friday with What's Hot, What's Not. Today's agenda, I'll be doing a workshop on big picture indicators. I hope you enjoy that. 10 and 10, our first symbol is going to be Nokia. And finally, we will finish. Tom is going to do a segment on intermarket analysis. So exciting day. Let's go ahead and get it started. Technical news and headlines. Let's hear a little bit more about those earnings and economic reports.
All right, well, let's start with the economic reports today. You can see September industrial production actually was a little hotter than expected. That did come in 0.3% higher versus the 0.2% that was expected. September capacity utilization, though, actually dropped a little bit, or certainly was less than expected, 78.1% versus 78.2%. And then maybe a little bit of a turn. We'll have to wait and see how the housing market reacts here over the next few days. But at least today, positive report in housing. We got the October housing market index coming in at 68 versus 67. So all of that, of course, once we get these economic reports, I like to take a look and see what's going on in the Treasury market. And you can see that the Treasury yield is relatively flat. We gapped up at the open with some of that economic news, but we've pulled back and currently just sitting very close to where we ended the day yesterday, 3.16%. We are continuing to hold this rising 20-day EMA on the 10-year Treasury yield. So I think as long as we continue to do that, we've got a nice uptrend in play. And it'll be interesting to see if the yield does move back up to 3.25%, what the equity market does, whether or not the equity markets move back down. I can tell you historically, and we'll talk about this a little bit more later in the show, but historically, when the yield's going higher, the S&P 500 goes higher as well. But that remains to be seen whether or not we will get that. All right, let's turn our attention to earnings, because this is a very big part of earnings season, just getting it started. We had the banks last week, and we got a number of solid, large cap companies that I think everyone needs to pay attention to. Here are just a few of them. There are a number of companies that have reported. So just wanted to give you some of the big names. Goldman Sachs, you can see, reported better than expected earnings. Actually, right down this list, Goldman Sachs, W.W. Grainger, Johnson & Johnson, Morgan Stanley, and Unitedhealth Group all reported better than expected earnings. But that doesn't always translate into higher stock prices, and we're going to take a look at that right now. So first, let's take a look at Goldman Sachs. Goldman Sachs, you can see on the chart, this is a one-year chart. It actually topped back in March, has been trending lower, and just recently broke down below this 220 level, which was prior support from late June, early July. Now we're coming back up. We are up slightly. We're up about 1% on Goldman Sachs earnings report, but struggling to get back through this prior price support level, which is now resistance. And if we take a look at the weekly chart, you will see that this range from 210 to 220 is going to be a pretty big one to see which way this goes. If we go all the way back, this is going back about a year and a half. You can see 210 on a weekly basis has been holding as support. This week, we were down as low as 213. So that's a pretty big level from an intermediate term perspective. And then to the upside, as I just showed you on the daily chart, we need to try and get back through this 220 area. Let's take a look at another chart, GWW. W.W. Grainger did beat on the bottom line, $4.19 versus $3.96. Anybody who was just looking at that bottom line and woke up and saw the result of how the market is treating Grainger today may be a little surprised, but there was a negative divergence on the weekly chart. We talked about this, I believe, on might have been the 10 and 10 yesterday, or I know we've looked at it recently, but with these higher highs, you can see the lower PPO, weekly PPO. And one of the things I pointed out in August when we were making these new highs, look at the volume. Volume was coming out of the stock. So we had a negative divergence on a weekly chart, which can be damaging. And then that was also corroborated by lesser volume on the breakout. And look at what's happening. So I'm not sure it would have mattered with Grainger whether or not the numbers on the top line beat or not, but they didn't. They came up a little bit short. And I think traders were just looking for something to take this stock down. Now, the question is going to be whether or not we can hold on to this 50-week moving average. And I'm beginning to have my doubts. And the reason, when we look at a relative chart, so this is Grainger here at the top, industrial suppliers have been on the decline for a while. And while Grainger actually held up pretty well versus its peers, now that it's come up with a little bit of a disappointing earnings report, especially on the top line, you can see how quickly the relative strength has deteriorated versus its peers and versus the S&P 500. We are at the lowest level we've seen relative to the S&P in the past 6 months or so, and the group is quickly deteriorating versus the S&P 500. So I think Grainger has a little bit more than just a negative divergence here to worry about. J&J, let's pull up Johnson & Johnson. Nice move up into latter part of September when pulling back. You can see we've got a nice reaction. Stock's up about 1.7% today, but I see some issues with Johnson & Johnson. First of all, the recent breakdown was at 138. We got to 138 and we failed. Also notice that tail went above the declining 20-day moving average and we failed. Another problem here is again on the relative chart with Johnson & Johnson. Pharmas have been doing extremely well, And that certainly has lifted J&J. But look what's going on a relative basis. J&J is going up because the overall group is going up, but it is in no way a leader among the pharmas. In fact, it's a laggard. And the only reason the stock has been outperforming the S&P 500 is because the group has been outperforming the S&P 500. I think the pharmas look good. I just don't know that Johnson & Johnson will be my pick within the pharmas right now. Morgan Stanley. So Morgan Stanley came out, nice report, beat on the top line by a pretty good margin, 9.87 billion versus 9.55 billion. Bottom line, $1.17 versus $1. And yet here on the move up, nice 4% gain, but we've been declining into this earnings report and on some pretty heavy volume. And on this gap back to the upside, you can see that has not been enough yet to get through price resistance and the declining 20-day moving average. So I think Morgan Stanley's got some work to do. Also, if we look at a weekly chart on Morgan Stanley, look at these failures over the summer, trying to get back through that 20-week moving average. That is declining, pulling away from the 50-week moving average. The weekly PPOs below the center line pointing down. I don't know. I'm not really liking this one very much. And if you take a look at it relative to its peers, you can see it's been going down. The group's been going down, but it's actually been going down faster than its group. So we've talked about these relative charts, how we really like to see them going up from the left side of the chart to the right side of the chart in all of these different panels. And yet this one's doing the exact opposite. Morgan Stanley's going down. The investment bankers or investment services going down. You've got Morgan Stanley relative to its peers going down. Morgan Stanley relative to the S&P going down, and the peers going down versus the S&P 500. So this is really the polar opposite of what you want to see from a relative strength standpoint. So yes, they beat earnings, but the company's got a lot to in order to strengthen here. So I would be really careful with Morgan Stanley. Take a look at Unitedhealth. I think Unitedhealth looks pretty good, even though it's been consolidating here. We didn't get the breakout. The PPO had gone just below the center line on the daily chart, starting to turn right back up again. Nice volume after we hit the bottom recently. There's some mixed signals, but certainly I think Unitedhealth looks a lot better than some of the other stocks that I've looked at. Here, there is a negative divergence, which worries me a little bit as you keep going higher. You can see we're way below where we were back in January. And even recently, as we've been trying to get through this 270 level, you can see that weekly PPO rolling over. So there are definitely some concerns here. But on a relative basis, there are some good things with Unitedhealth Group. First of all, it's part of the healthcare or health providers index, healthcare providers index, which has been moving up. And if we scroll down here, you'll see relative to the S&P 500, this is a really good group. And that has led to outperformance in Unitedhealth. And Unitedhealth just broke out versus the S&P 500 to a new high, a new relative high. But with the group being so strong, the one thing I don't like is that we have been in a steady downtrend for about 4 months with UNH relative to its peers. So it's in a great group. It has continued to perform pretty well. But I think what this chart is telling us is that there's some other healthcare providers we probably should be looking at. A few more earnings reports that we did not mention on that opening screen, but probably worthy of mention. Let's talk about Domino's Pizza. DPZ, talk about a great bottom line. A $1.95 versus a $1.73. Really huge beat on the bottom line, more than 10% better than expected. And the stock for all of that is down almost 5% today. Why? Well, revenues came up a little short, $786 million versus $789.1 million. So that probably is a little bit of a concern. I give this one a pretty good chance, though, maybe holding on to this support area around 250 to 255. And the reason being, you can see the restaurants and bars have started to pick back up to the upside. And so even though today's reaction to earnings has created a short-term breakdown in relative strength relative to its peers, the peers itself have been gaining against the S&P 500. And you can see that the last pullback in relative strength, we have not broken down below that level. So I think if Domino's can hold on to its 250, 255 level, I wouldn't be surprised to see this one begin to strengthen again. It came up just barely short on revenues, And like I said, that earnings beat was pretty solid. A couple of others maybe to take a look at quickly. INFY. INFY performing very well, up 6% on this earnings report today. They did beat on the top line, $2.92 billion versus $2.79 billion. Bottom line, they just matched, though, 13 cents versus 13 cents. But I would argue that with this recent weakness over the last month or so, it looks to me like maybe traders were expecting something a lot worse than what INFY delivered. So I think from a relative standpoint, I think the reaction here is quite strong. So the group that the INFY is in the computer services space, and you can see the DJUSDV had been on a very steep decline. And part of INFY's weakness, I would say, was simply just moving lower with the overall group. But I think this recovery and getting close to its high when the overall group is still well below that high, I think is a good sign. And what that's allowed INFY to do is break out relative to its peers, break out relative to the S&P 500. Here is the problem with the stock. You can see here that computer services relative to the S&P 500 are just now bouncing off of a 2018 relative low. So the group has not been performing well, but INFY has been performing very well relative to the group and the S&P 500. So I think you can make an argument with INFY, especially if this short-term relative strength in the group continues. PGR, this is Progressive. I'm just going to show it on a relative basis because this is a stock that is really performing very strongly versus its property and casualty insurance peers. Here you can see the stock pulling back the last week before earnings, but look what the overall group has been doing. So I think PGR has simply just been pulled back by the weight of its peers. And you can see on a relative basis, look at PGR relative to the property insurers, property and casualty insurers, and then you've got PGR strengthening relative to the S&P 500. Once again, like computer services, you've got the property and casualty insurers that just aren't performing very well on a relative basis. So you got a great company within a group that needs to gain traction. So if the group overall begins to move higher, I think you got a pretty good stock here. OMC, this is Omnicom Group, OMC. It is in the media agencies group. And the problem with the stock, they came out with a really nice report. 3.71 billion revenues versus 3.68. Bottom line, $1.32 versus $1.21. So you got a nice beat on both top and bottom line. We got a pretty nice reaction. But when I look back at this stock over the last year, I just am not excited. It's just a sideways, yeah, we get a little bit of strength going and then we come back with weakness. Now we got strength. I don't really feel like I can count on the stock. And part of it is because I can't really count on the group. I've talked about this group in the past, and it's had some periods where it looked like it was breaking out, only to get swept back into this going nowhere trend. And you can see relative to its group, it's been up, it's been down, now it's going back up again. The overall group has really struggled, well off its relative high from earlier in 2018. And you can see, or actually OMC relative to the S&P was well off the high. And its group also well off the high versus the S&P. So a lot going on there. Maybe one more chart that I wanted to look at here. Let's take a look at Adobe. Because Adobe did just come out with an increase to its revenue estimates for 2019. I think that's a big deal because the software group definitely needed a lift after the October it has had so far. And we are starting to strengthen here again in the group, which is a good sign. Adobe relative to its peers with that reaction today also beginning to strengthen again. And you can see Adobe is not far from breaking out relative to the S&P despite its group's woes so far in the first half of October. And here you can see the software group trying to make another technical breakout as well relative to the S&P. All right, I know Erin's got a workshop that everyone is patiently waiting for. So Erin, why don't you take it away?
All right, let's get this started. I'm going to talk to you all about advanced market indicators or big picture indicators today. So let's go ahead and start this. Okay. So big picture indicators. What are the big picture indicators? Well, they're the market indicators. and they tell you the health of a market or an index. It gives you the big picture. You're not looking at simply an individual indicator like we look at the OBV or the scooter. We're looking at indicators that are going to tell us the health of the market or the index in general. And the easiest way to do this, and I do have a poll running, so go ahead and take it, is to download DecisionPoint ChartPacks. We have a couple of different ones I'll talk to you about briefly, but we're going to really concentrate today on the market indicator chart pack. These have the primary market indicators that I use pretty much every day, the ones that you'll find in the DecisionPoint chart gallery. Those are the primary ones, and I'll talk to you briefly about those, but since I cover those pretty much in every other blog that I write, I'm not going to get too detailed about reading those and what we accomplish with those. And then I'm going to go over what I would call the secondary market indicators, and we have a boatload of them. I will show you the ones that we have. I'll go over some of those chart packs and chart lists with you and give you an idea of how you would use these various market indicators. So first of all, with DP analysis studies, there's pretty much two ways to go about it. And we have chart packs that really give you that opportunity to study the market from two different directions. And one I would call is market focused, meaning you're focusing in on one particular index or one particular well, mainly indexes is what we have in there. And you want to look at straight shots or trending condition. You really are concentrating on that one index. You can get some market indicators out of that, but in general, what you're looking at is just focusing in on say, the S&P, and then looking at all the different indicators for the S&P. But what I'm going to go over today is the indicator-focused studies, where you actually start with the market indicator and then look at it across all the different indexes. And that can give you an idea of, you know, we've been talking about how technology is very weak right now, that, you know, we're seeing some problems in finance, but yet utilities are doing well. Those kinds of things you can look through and just look at those market indicators to help you get an idea what's going on across the board as far as small, mid, and large caps. So in particular, these are what we're going to go over. So it's a lot of them. Like I said, I'll go over our primary indicators, the PMO analysis charts, advanced decline, McClellan Oscillator, new highs, new lows. We have, like I said, a boatload, and I'm going to really just scratch the surface with all of these, but I will show you how you can get more information about them. So let's go ahead and move on over to, all right. So what I'm going to show you, if I can get my arrow to come and show up for me. I'll hang on here just a second. There we go. Okay, so what I'm going to concentrate on, like I said, are these DecisionPoint chart packs so that you can get these market indicators. So the way you download a chart pack, and I'm going to do it right here and right now with my Market Watchers account. Just go to your account, manage chart packs, and this is going to give you the list of the various chart packs we have. A chart pack includes a number of chart lists with a lot of different charts within each chart list. Now, I'm going to caveat this right off the bat and tell you that you do need to be an extra member or above in order to download a chart pack. They are free, but you need to be an extra member or above because basic members can only have one chart list. And of course, these chart packs include multiple chart lists. So you'll need to be an extra member, but why wouldn't you? These chart packs are fabulous. So here are Arthur's. These are the DecisionPoint ones right here that I'll talk to you a little bit about. So the straight shots and trend and condition, like I said, you're going to start off with your index that you're interested in, or, you know, if you want oil or gold, those are where you would go to your straight shots and your trend and condition chart packs. The intraday chart pack, I'm not going to go over, but it's a great one. It's got 10-minute bar charts across the board. This is the one that I'm going to concentrate on, the DP Market Indicators chart pack. And the best part of these is that we have created all the charts for you. And here are all the different ones. And as you can see, a lot of what I'm going to talk to you about, these are all included in the market indicator chart pack. And I'm going to install it. It's very simple. All right, and I'm going to go down to my chart lists. And there you go, the DPMI, that's the chart pack. So these are all the chart lists that are included in that market indicator chart pack. All right, so let's go ahead and start off with the DP market indicators that I use primarily. And those are going to be the ones that are in your DecisionPoint chart gallery. The chart gallery is fairly easy to get to. Let's go ahead and start right here. Go on over to your control center. And if you scroll down, you'll see the DecisionPoint chart gallery. And the condition charts, these are some of the ones that we're going to look at. These are the ones I look at every day, the Swendlin trading oscillators and the ITBM and ITVM. Those are primary indicators that we use to give a health of what's going on within a market index. So I use those all the time. I don't want to go over those in particular just because of the fact that we don't have enough time. So I will probably do a workshop just simply on that. So let's go ahead and just start looking at a few of these. I'm going to start with our PMO analysis charts. I'm going to do the ones that I think are the most important. So if we run out of time, we'll run out of time on the ones I don't think are as important. All right, so what you're going to find with most of our chart lists is that when you go into them, you have not only the S&P, but you also get the other indexes that we cover for that particular indicator. And for the PMO analysis charts, we do have the 4 scoreboard indexes here. So I'm going to pull up the Nasdaq. I think I'm going to kind of concentrate on the Nasdaq 100 as we go through these. And forgive me, these charts are, formatted the way you get them when you go into that chart pack. So I'll just make them a little bigger here for you. So we're looking at the Nasdaq, and these are the PMO indicators that we look at for the analysis. And what we want to see is how many of the 100 components in the Nasdaq have PMOs that are rising, how many are on PMO crossover buy signals, so how many are on PMO buy signals, and then finally, the percent PMO above 0. Now, I consider this a big picture indicator because it tells me the health of the Nasdaq 100 in 3 different time frames. I have the short time frame. It just tells me whether momentum is rising or falling for the components. The intermediate term is whether they're on a buy signal, because it takes some time for the PMO to make a buy signal. So that's more intermediate term. And then the longer term is just how many of the PMOs are currently above 0. So I'm looking at this. What are we able to see about the NASDAQ 100 right now? Well, some of the important facts is you can see all of these are pretty much in oversold territory. Right now in the NASDAQ 100, only 14 are rising right now, have PMOs that are going upward. So all of the others have negative momentum right now. So you want to start looking in the short term for this to improve, obviously, and that will tell you that the NASDAQ 100 is getting more healthy. Look at this one, though. The crossover buy signals, right now only 4 out of the 100 components have crossover buy signals. We're looking at some very oversold conditions as far as these indicators go, and you're going to see that on a lot of these indicators. This isn't to say that they can't go lower. It's not just because they're down at the bottom or they're sitting at the top that it's going to immediately change. One of the things I would point out, especially is when you're looking at the PMO above 0, a lot of times that can persist for quite a while because the PMOs stay above 0. But right now, this is very interesting. You could see we had a declining trend here on those PMOs above zero, and now they're falling oversold. Okay, so that is the PMO analysis charts. And like I said, there are 4 different in here, and you can get a peek at what each of them are telling you just very easily. I just love this when you look at it. So what are we seeing in the S&P versus the Nasdaq? Well, we still have very oversold conditions, clearly. Typically, when you get into these oversold conditions, that's when you see market bottoms. There's one back here, I believe, right in here. We had a bottom back in here. So what you do, obviously, is like with the PMO or any indicator, oversold, overbought conditions. But like I said, these conditions can persist, especially on the longer term. All right, so that's PMO analysis charts. Let's go ahead and look at the McClellan Oscillator. Tom McClellan's on the show often, and he's got some great indicators, but the ones that his parents came up with, the McClellan Oscillator and Summation Index, are fabulous to use. We have in that McClellan Oscillator chart list, you can get the McClellan Oscillator for all of these different indexes. So even the small caps, we can look at the McClellan Oscillator for small caps and get a feel. Wow, look at that Summation Index. Clearly very, very oversold in the small caps. We had a condition back here where the McClellan Oscillator was hitting lows we had not seen since we had that big correction back in January, February. So you can, again, like I said, we can look at the various ones. I told you we'd concentrate a little bit more on the Nasdaq. All right, so when we look at the oscillator here, one thing I noticed just right off the bat from comparing the S&P 600 to the Nasdaq 100 is the summation index is well above zero pretty much the whole time. And if we look at the small caps, look at how far below the zero line. So we're looking at small caps are even further oversold than the Nasdaq at this point. And again, there you go. I won't explain each indicator, but what I will note for you, and if we go back here to our main page. Okay. With all of these chart lists, when you download them, there is chart notes to tell you what to look for and what we cover. So it's very high level, but at least it'll give you an idea of what some of these mean and how we use them. Of course, Chart School will give you excellent opportunity as well. All right, so let's go ahead and I'm going to move on to looking at the new highs, new lows chart lists. And again, you can get it for various different indexes. And this is why big picture, this is what is so great, is you can come in and look at a particular indicator and then look at it across all of the different indexes and make comparisons. You're able to see which ones appear stronger versus weaker. Like we looked at the McClellan Oscillator and we saw the summation index for the 600 was far more oversold than it was for the Nasdaq 100. Just interesting information to see, but I love being able to go through and look at these for all different indexes. All right, so let's go ahead and we'll peek at these. One thing that you can also do when you're going through these, obviously, is to arrow through. So if you want to get the picture right away on what these are each telling you, you can just arrow through. There we go. What we're looking at right now are the new highs, new lows chart lists. And these are very helpful, again, for finding overbought, oversold conditions. And I believe if you come further down here, oh, no. So anyway, what I like to watch are obviously the 10-day moving average. I find very, very interesting because typically with these, you're going to see those oversold conditions, those bottoms on this particular the 10-day moving average, like I said, of new highs minus new lows. The bottoms on these typically do pull out price bottoms. So I'm going to just make this a little bit smaller for you all to be able to see it together so I can show you. I'll make these better for you. There we go. All right, now you can see everything, and I'm going to go ahead and annotate this. Make it big. All right. Okay, so we're looking at new highs, new lows, histogram. And like I said, the one indicator I like within this chart list are the 10-day moving average of the new highs, new lows. I think these are great. I'm going to just use a vertical line. Let's make it something you can see through. That looks all right. And I'll just add them into where I see these bottoms that have come in on these indicators below the 0 line. And I'm just looking at the indicator here. We'll just see how they match up. So those are bottoms that I caught here. Let's see, here's one way back here and one back here. And where do these line up on the grand scheme of things? Of course, with the price chart, that's what we really want to know. As you can see, it's a pretty darn good indicator to give you those price bottoms or to let you know when we should start looking for prices to rise. So what is that telling me right now about what we have currently? Well, we're decelerating. We don't have a bottom yet. We could continue lower. We've seen it before back here in 2016. I'm going to be watching to see when we get a bottom on this indicator, because I think that would give me a better sense that we're out of the woods right now. All right, so that is those, and I'll just leave those on there. And now they'll forever be in that chart list there. All right, so let's see, what are we going to look at next? Let's go to the put call ratios. All right. And with these, we have it just for the OEX is shown, and then the raw put call ratios. So that's how we have these. I go over with you on Fridays when I do the sentiment report, because looking at put call ratios, again, it can give you an idea of when the market is particularly oversold. So I'm going to just change this to a 1-year chart, and I'm going to make it to where it's easier for you to see it. And we'll make some comparisons here. All right. So again, put call ratio. So when we get numbers that are very small, that means that people are very bullish because that's in the denominator. And when we get numbers that are larger, that's going to obviously show you oversold conditions when people are more bearish. Typically, like with sentiment, when you see these oversold conditions, when people get especially bearish, that's when we start looking for those price reversals. So what is this one telling us just based on that? I'm just going to use these vertical lines. And where are some that stick out to me? I'm going to look at the first two panes, because the third one doesn't always, the OEX put call ratio doesn't always match up. And the reason for this, from what I'm just gathering from the people I have talked to, is that it is related to hedging, that a lot of times people use the OEX put calls for hedging, not necessarily for how they feel about the market right now. So I'm going to look at some of these lows. That looks like a good one back here. Let's see. Oh, that one's good too, I think. That's fairly good. So where do these line up, you know, when we're getting these lows? Well, obviously they don't line up perfectly every time, but typically you can see that those oversold conditions, when people are especially bearish, that's when you start looking for the turnover there. And, you know, when I'm looking at this now, what is it telling me? You know, we're starting to move back up, people are feeling a little bit more bullish. Well, that makes sense, you know, based on the rally that we saw yesterday, rally-ish, and today. So it makes sense that we're seeing these rise, but the bottoms are already put in. So that's one reason why I'm thinking this could just be, you know, a last stand before we start moving a bit lower. But we'll want to watch and see if we get into that overbought, those overbought conditions. All righty. Okay, what do I want to look at next? Let's go ahead and look at, well, certainly don't want to look at that. All right. Okay, so we've looked at new highs, new lows, put call. Let's go ahead and go to the stocks above the 200-day EMA. Take a peek at these. All right, again, so we can do this study for the NYSE, Nasdaq, Nasdaq 100, et cetera, including mid and small caps. Now, a lot of indicators, you're not going to see these on all these different indexes. Typically, a lot of times what you see, especially on you know, other research sites and such, is you'll get these for one particular index, typically the S&P or the NYSE. So it's nice to be able to look at these various indicators across the board to see what's going on amongst all of them. So as you can see right now, this is another one of those I like because you have 3 time frames on one chart. You have the short term here. Actually, it goes the other way. Longer term is on top because how many stocks are above their 200-day EMA, how many are above their 50, and how many are above their 20 within, in this case, just the Nasdaq. Let's go ahead and look at the Nasdaq 100 since I did say we would sort of stick to that one today. And I'm going to make this smaller so we can all see it better. Oh, that's probably not going to work. Give you time to digest all of this. All right, so this is the Nasdaq 100, and we're looking at the stocks above their 250 and 20-day EMAs. Clearly, we're in oversold territory here. And that's, again, where we start looking for reversals. So I'm going to just do what we did last time. I'm going to go down here to the indicators and look for where we had oversold conditions, where we flipped it around. So that's a good one. I think that would be good, possibly in here. I'll take a peek at one. Right now, guys, I'm just looking at the indicator. I'm not looking up top. So I don't know where they're lining up. I have a pretty good idea because I do study these, but just to look at a few. And there's a big one there and a big one there. All right, so where are these lining up on the price chart? Again, you're seeing how well they do work as oversold, overbought indicators. So what are we seeing right now? Well, I would say yesterday, I would be feeling a little bit nervous because we had turned up on all of these indicators. And now we're starting to tick back down. These are as of yesterday. So we'll have to see what happens at the end of the day. I suspect if we obviously continue a nice run like we're seeing with the Nasdaq 100 up over 2%, I would expect these to continue higher. So this could be, as far as this indicator is concerned, it'll give you the talk about a bear market versus a bull market, wins the price reversal. Well, this chart kind of tells us that we're looking at a price reversal in the making to the upside. But, you know, we've seen where you go into the up, down, and you still continue lower like a bear market. So I'll be watching this one pretty closely. But right now, you know, what it's telling us at that bottom is we should start to expect some more upside momentum. All righty. And just for the heck of it, let's look at the S&P 600 just so you can see how we do have this for all of the various indexes. S&P 600, we're looking pretty ugly here. We only have 7%, a little over 7% of the small caps above their 20-day EMA. we've got only 10% above their 50. This is, typically you don't see these numbers on the top two take a dive quite as quickly, which is obviously concerning. But the good news is, like I said, is we're sitting here in very, very oversold territory. I mean, what it's telling me is we should start looking for that price reversal on the Nasdaq 100, on the S&P 600. It is up 1.75% today. The question is, of course, is this going to be just a short-term bounce followed by more correction? When I look at these particular indicators, it certainly gives me makes me feel a little bit more optimistic. All right, so the last ones I'm going to look at are the volatility indexes. And these are, again, these are all set up for you. You saw me download this chart pack. These are right there for you. You can see that price has now gotten into the Bollinger Band here for the S&P 500. We look at the VIX very often. But one thing we don't look at are the volatility index for all these other particular indexes, and even with gold and oil. So Nasdaq 100, I said we would look at the VIX there. This is not an inverted scale, which I normally use. So by seeing the penetration to the upside, that's when I start looking for bottoms. We got that, but now we're back inside the Bollinger Bands. That tells me that, while we are in that top part, so that makes us more vulnerable to downside action. When it gets to this other part of, when it gets to the lower side of the Bollinger Band, that's when I start to feel a little bit better about getting into the market, re-entering. Currently, with it being below its average right now, or I should say well above, that isn't the kind of situation I want. I want to look at when we have the volatility index on the low side or below its moving average. And if you look back here, if we had waited until that moment in time, that would have put us back in here to get some opportunity off of that rise. Once you were in, it's just one of those things Tom and I talk about, Tom particularly, that when you have, such high volatility index readings, that's when you're, the market is vulnerable to all kinds of corrections and wide-ranging snaps to the downside, the upside. Better to just stay on the sidelines if possible. And then, like I said, we even have the gold volatility index here. Finally, I was just going to let you know that we also have the sentiment indicators in here that I go over. The AAII, as you can see, name, Wall Street sentiment. So all of these are also available to you. So let's go ahead and conclude this up here. Oh, I didn't want to do that. All right. So really what I wanted to let you know, or here are the takeaways for today's workshop. So I gave you kind of the definition of a market indicator versus a, one of the, like a stock indicator, the ones we use for an individual stock. Market indicators are big picture. They're going to tell you what's happening with all of the components within an index. And you can do indicator studies and index studies. And what we looked at was really the indicator studies, looking at an indicator across all of the different indexes. And then finally, I showed you how to download those DP chart packs. They are free, but remember, you do need to be an extra member or above. And that's all I have for you today. Let's go ahead and maybe bring up that poll that we had. Just, I'm curious to know what everybody's thinking. So of that 43% of you, if you are an extra member, I expect that to change to a yes after my presentation today. To that 35 or third percent out there, yay. Glad to see I've got some DP fans there. If you didn't know what a chart pack was, hopefully today with my demonstration, you do have an idea of what one is. And like I said, very helpful, but you do need to be an extra member or above. And what do you think about chart packs, Tom? Have you downloaded any?
I actually did download Arthur's chart pack because he had a number of ETFs that he had already put together these lists. So it saved me a ton of time. In particular, I know there were some small cap ETFs that track the sectors that I use relative to the large cap sectors. So it saved me a ton of time. So I would highly recommend that folks take a look at these chart packs, and they are free.
Yeah, absolutely. And the other one I didn't talk about was the stock charts essentials chart pack, and that one is a great one if you need some of the basic market indicators. Those are in there, and it also gives you kind of an outline, a way to organize your chart lists as well. So I recommend that one. That's all I got. So I guess it's time to move into the 10 and 10. I obviously don't have an RRG. I'm going to be madly putting in the symbols that I didn't already put in from earlier. So let's go ahead and get started with that, and go ahead and do the first one, which is Nokia, and get there and vote in the chat room. The most popular, most liked symbol will be the next one we look at.
All right. Well, first, Nokia, I'm not a big fan. I mean, we did have a nice gap up. We're moving higher today. Obviously, the market's helping to lift the stock, many stocks. But overall, you can see over the past few months, we've been downtrending, even though the telecommunications equipment group has been moving higher. So I just think Nokia on a relative basis, and this is what this points out, relative to its peers, it's not only well below where it was 2 or 3 months ago, but also well below where it was a year ago. And you can see relative to the S&P 500, it's been struggling. I would think, if there's a point that I would watch is maybe right around this 0.00196 area, right about in here, because that was a relative support level. We broke below it, we tested it, and now we've been sideways consolidated. Maybe if we could get a breakout there, we would start to see some more strength on Nokia. But the problem is, after we see some strength, and we see technical strength and some breakouts, it just seems to get followed up with action that's just not very bullish. And in a 10-year bull market, that's a little disconcerting. So I'm just not seeing anything here on a relative basis, other than the group. The group's been pretty strong relative to the S&P 500, but Nokia, even with that environment, has been struggling. So if I was going to play the index or that area of the market, I think I'd look elsewhere.
All righty. The most popular in the chat room right now, it appears to be, is there a tie? No, Square. Boy, by a mile. So
yeah, I actually like Square. I think, you look at the daily chart and you see a lot of issues. Big volume, breaking down below the moving averages, 20-day getting ready to cross the 50, PPO moving deeply into negative territory, which we haven't seen in a while. But I think you got to keep everything in perspective. Here's a stock. This is a 6-month chart. The stock was down under 45 back in April, just hit 100. So, I mean, these stocks do need time to pull back. They had their CFO resign to go. I think she became a CEO at another company. And so that kind of came in right when all of the selling took place in the first couple of weeks of October. All the financial administration stocks were getting hit. Some of the areas of the market that have been leading, software, financial administration, those types of stocks were really getting hit hard. So I think Square just kind of got all, kind of picked up in all of that mess. I think it's better to take a look maybe at a longer term chart. And I think when you look at a longer term chart, it kind of gets rid of some of that noise that we've experienced here over the past couple of weeks. I still give Square a decent chance. I'm not saying it's going to go scorching back to the upside, but I do think that there's a good chance that this overall uptrend remains in play. And do we go back and retest that 65 area? I think that's possible, but I think the longer term picture here with Square still looks pretty good. I'm still bullish Square despite the weakness that we've seen of late.
all righty, let's go ahead and do Baba. We haven't looked at that one in a while. Alibaba.
Yeah, Baba, unfortunately, is in a couple of bad spaces. Big space that they're in that's bad is China. China has just not been very strong, and so many of these Chinese stocks have really gotten hit pretty hard. Baba was 210 back in June, just hit 135 last week. That's a pretty sizable haircut. And what maybe is just as bothersome is when we pull up the relative charts, Alibaba's in that broadline retail space. And the overall group, yes, it's pulled back some, but it hit a high at the beginning of September, and you could already see the relative weakness. And again, a lot of this relates back to China and some of the issues there. But just take a look at BABA relative to the broadline retailers. It's been horrible. Relative to the S&P, it's been horrible, yet its group has actually been pretty strong. So I think I wouldn't be a fan of Alibaba until we break out of this down channel. You'll still have plenty of room to the upside. I think that all of these moves that we have been seeing, there we go. And trying to figure out exactly where this line should be. Kind of thinking it's something like that. But this to me looks like a channel that we continue to move lower in. Now, we're not going to stay in this channel forever, or Alibaba in the next 6 months will go to zero. And that's probably not happening. So eventually we break out of this channel. Let's see if we can get some volumes, start to see some relative strength, and then maybe take a look at Alibaba. For now, I think the downtrend, there are just too many other stocks that have held up much better, and I think are much better plays here. So I personally would avoid Alibaba right now.
All right. This is one we haven't looked at. An industrial gas log limited, GLOG, G-L-O-G.
All right, GLOG. You got to like that ticker symbol. I
Right.
also like this volume on these breakouts. I mean, that's a nice flag pattern that we're just getting a solid, I mean, really heavy volume breakout for this stock. But there is some sideways consolidation, and all of that follows a really significant uptrend where this stock had moved up from 15.5 to 20.5 in just a little over a month. I mean, that's about 33% rise. Here's your flag, and then here's your breakout on volume. Best entry would be a pullback to that 20.5 area. Maybe you get down to the rising 20-day moving average, but I like the chart. I think it goes higher.
All righty. Let's look at another big name here. How about Walmart?
All right, Walmart, I think it's trying to put in a bottom here after gapping up, pulling back. It's in this gap support zone. Maybe it goes below the 93 level, but I'm going to say no. I think the fact that we put in an equal high to that second week of September, and I'll show you that here, right there. When we pulled back, we had a move back up to 97.5, put in lower lows. So normally you would expect a lower high, but in this case, we actually had false breakout, tested that high, went back down, and I think as long as we hold 93, I'm going to guess that we turn back to the upside. I think we're going to see an uptrend and a cup form. I look for Walmart to head back toward 100.
All right. Let's see. How about Medifast, M-E-D?
Right, Medifast. Holding on to gap support and price support, so I'm okay with this one right now. Best thing it needs to do first is get above that 20-day, and I'm seeing that on a lot of charts right now. I think that'll be our first clue when we start seeing some of these prior leaders get back through their 20-day. Here you can see the move down. Nice hammer, kind of established this low near the bottom here, which was price support and gap support. Moved back up, but notice we can't get through the 20-day. We're right up against it today. I've seen a lot of stocks moving back up and testing that 20-day moving average from underneath. If we fail and we roll back over, I think we could bring that 180, 175, 180 area back into play. Short term, 197, 198. We haven't had a close or an open below that level over the last 2 months or so. So that's your short-term support. But I think the bigger one would be down here at about this 175, 180 area.
All right. Let's see. Next one. We haven't talked about this one in a while. Voya.
Yeah, I'm a little surprised. This one made a nice breakout, and I really thought it had something going. Life insurance was starting to perk up a little bit with the 10-year Treasury yield breaking out, and then we got a false breakout. And, pulling up a relative chart here, and this is where I think, I've said this before, that when you're getting a stock or like gold, in that case, just a different asset class, when you're getting a breakout and it's a group that has been underperforming, you want to make sure you keep your stops in tight, because you don't know if this is a real breakout or a false breakout. And I think what we've seen now is that Voya had a false breakout to the upside and then potentially a false breakdown to the downside. But if you look at life insurance relative to the S&P 500, you're in a group that is underperforming the S&P. You're in a stock that's been underperforming the S&P, and you're in a stock that over the past 4 to 5 months has been underperforming its peers. So when you get the breakout, if it fails to hold, I think you really want to be careful and make sure you keep your stops. I think you want to keep your stops in play on any trade, but especially on areas of the market that have been underperforming, because I'm always worried about that false breakout. So here in annotating Voya, I think for me, it's just really about trying to get back up through this resistance area, which we did, couldn't hold it. And now you can see from a longer term perspective, you've got those tails there. You can see this is the bottom of gap support from all the way back in the end of 2017. And so this area you can see is held now on 3 different occasions. You want to hold this because I would trust a breakdown, because this is a group that has not been performing well and a stock that has not been performing well. To the upside, if it breaks out, I'm going to be a little bit more leery.
All right. Hasbro, toys, HAS.
Yeah, toys they were having a really good day earlier today when I was looking at the industry performance. And you can see Hasbro doing very well, holding on basically where I think it needed to. Looking down, it's been a relative outperformer versus the S&P, even though toys have been moving against the S&P. So I think you have a pretty good stock within this toy group, and it is holding the support level around 97.5. So I think here in annotating, that would be a key area for me to watch to the downside. 97.5 after gapping up on massive volume back in July. We have been holding there. Now to the upside, I'm a little concerned because now we're approaching what I was just referring to, which is that 20-day moving average, which is just now crossing beneath the 50. So if we fail there and go back down, make sure you keep that stop in, or the stop in play. And I'd keep a fairly tight one, because if it does break below 97.5, your next gap support level, the bottom of gap support, will be all the way down around 93.
All right. We didn't talk about gold today, I don't believe. Barrick Gold, so it's a gold miner, ABX, one of the popular ones.
Yeah, and I think ABX is kind of in that area where you can see right here, its group has not been performing well. The stock has been performing well relative to the group, and the group has just started to begin to outperform. So this is one of those where you're seeing a lot of these relative charts moving from the left side of the screen down to the right side of the screen, which is not a good thing. So if I'm playing this, I like the volume trends, I like the action, holding the rising 20-day, but I'm going to have a very tight stop. I'm not going to give it a lot of room if it fails, because I know this is a stock and a group that has not been very strong relative to the S&P over time. So a couple areas to watch here. To the upside, I think we may run into some pretty significant overhead resistance about 1370. And then you can see short term, what I would continue to watch for is that rising 20-day moving average holding. And you can see so far it's been perfect. Each time we move down, we hold it. Volume trend's great. So I think right now we're probably between, I'm going to call it around 1175 support, along with that 20-day right about there as well. And then your resistance around 1375.
All right. Let's see. The last one I'm going to give you is PAN-W, Palo Alto Networks.
All right. All right, Palo Alto. Well, it's down near some key support, and it's trying to bounce. And again, this is a little bit like Nokia in that here you can see this was a little bit better stock than Nokia until just recently. But here you can see the overall group breaking out at the beginning of October, and Palo Alto was already starting to weaken below its moving averages. So that means we have started to see some deterioration in relative strength, and we are currently at the lowest the stock has been relative to its peers in about 4 or 5 months. Part of this, I'm not sure about their market cap, but they may be in the small mid-cap area of the market where the market has been much weaker. So that could be explaining some of it. Maybe if the small caps and mid caps begin to strengthen, maybe Palo Alto will begin to strengthen as well. But I would personally be watching the area of support that is right at about 195 to 198 right in here, because that's where we broke out from back in May. And since then, that's the area where we've been holding on pullbacks. and we've had higher highs, so I don't want to see a lower low. This is a key area. I like the reward to risk here. The only thing, again, I'm a little concerned about is the relative weakness that's been building in here, Palo Alto, over the last few weeks. So if I get in, I want to make sure I keep my stop in play here as well.
All right. That would be it. That concludes the 10 and 10. And here are the symbols that we just went over. I will get these up in the Market Watchers live chart list after the program. To find those charts with those annotations, just go to the blogs tab and click on the Market Watchers live blog. You'll find the link right there at the top. All right, time for our final market update. All righty, here we go. All right, markets are still looking very good right now. We can see that everybody is up, including Canada, although Canada, we can see the TSX has started to pull back just slightly. And I'm starting to see a little bit of deceleration here on this move to the upside, but not enough to be too worried about the end of the day. I think we'll finish the day very well at this point. Mid caps, small caps also participating. Really, they're not even decelerating. Look at the Russell 2000 continuing to accelerate higher. We've got the TNX Treasury yields are down slightly, reading 3.161%. UUP is mostly unchanged. You can see gold has the big gap up, but it has pulled back. It is GLD is up 24 cents to 116.24. TLT bonds are only up slightly. TLT at 114.50. USO oil, it's on a rising trend that really started on Friday, but it has been a lot of choppy trading. Currently, USO is up 6 cents, reading at 15.19. And that's all I have for our final market update. I'm going to pass back to you, Tom.
All right. I'm going to go ahead and just take a quick look at the sector strength. So let me go ahead and get that up for everybody. And this is kind of what I wanted to see heading into today and really as we go forward. The market is strengthening. Recently, we've seen some weakness in some of the aggressive areas like technology, communication services, consumer discretionary, industrials, and so forth. But the market's been pulling back, and that's kind of normal for the market. When the market pulls back, we tend to see strength or relative strength in some of those other more defensive areas. But when the market is when it's strong and we're trying to make a push back to the upside, this is really what I'm looking for. I want to try to find, or I want to see strength in some of the more aggressive areas. So technology, healthcare, and communication services all being up more than 2% today, while some of the recent leaders like consumer staples, utilities, real estate, they are taking a back seat during an advance. So short term, this is good, but this is just one day. I want to see it continue so that if we do continue to consolidate and then eventually break to new highs somewhere down the road, I want to make sure that this is the type of configuration that we're looking at on the sector leaderboard. So I just wanted to point that out. I think the strength that we're seeing today is setting up in all the right areas, but we want to make sure that we continue that. I've got some concerns about the market still in the short term, even with this great day that we're having so far today. I've talked about it a little bit with many of the stocks moving up, trying to get through 20-day moving averages. I'm not sure we're just going to fly through those numbers. It would be great if we do, but I would be maybe just a bit cautious as we make another push back up toward those levels. Okay, I'm going to go ahead and switch it over now, and let's talk about Intermarket Analysis. And before I get into this, I really want to credit John Murphy. When I was studying some of the books that he wrote, and I'm for the most part self-taught in terms of technical analysis, but I do give John a lot of credit because I read his books, and some of the stuff was just fascinating for me. Technical Analysis of the Financial Markets. If you haven't read that book, I would highly recommend it. I think that it, for me anyway, it was very, it just followed common sense. When I started reading the book and it was like, okay, don't necessarily pay attention to what's going on CNBC. You need to watch how these ratios and these different markets are working relative to one another. It really started to click. And so again, I'm going to give John Murphy a lot of credit for some of the things that I talk about here. Some of it I've come up with on my own, but the incentive that he provided me in going through and reading his books was phenomenal. Really helped shape the way I look at the market. So let's get started. This is a chart that many of you have seen before. Certainly the ones that have been regular watchers of Market Watchers Live. This is one of my favorite charts to kind of keep track of what's going on with the dollar and what I expect to go on with the dollar. And so the first part of this intermarket analysis, I want to talk about some of those dollar effects. But before you can talk about dollar effects, you need to kind of have at least a game plan on what you think the dollar is going to do. Now, I tend to follow what's going on in the U.S. market versus Germany, not just with equities, but also with treasuries. And so the top part of this chart is just simply tracking the difference between the 10-year Treasury yield and the 10-year German Treasury yield. And you can see over the last 10 years throughout our bull market, this has been rising. And the way I interpret this is that our economy in the U.S. is strengthening faster than in Germany, and that is what is sending our Treasury yields up faster than Germany's. But if that's the case, if we're strengthening faster than Germany and other foreign countries, then our dollar should benefit from that. Our dollar should strengthen if our economy is growing faster. And when you look at this chart from left to right, you can see that the last 10 years, our Treasury yields have been going up much faster than Germany's. And if you look, back in 2011 is when the dollar index bottomed, and the dollar has been rising. Now, you don't see a perfect correlation here, and I have the correlation on this chart. You can see it does go in the negative territory, meaning that occasionally the yields in the U.S. have gone up faster than Germany's, but the dollar has gone in the other direction. And these are in these red shaded areas. And so that's what's created these negative correlations or inverse correlations that we've seen. But each time we've seen that, one of two things generally has to happen. We either need these Treasury yields in the U.S. versus Germany to come tumbling down while the dollar stays the same or moves higher, or we need to see the dollar playing catch up. And back in 2009, 2010, you can see the dollar went up rapidly to play catch up, and you can see the correlation went from negative to positive very quickly. Same thing back in 2014 to 2015. Huge run up in the dollar after we had this inverse correlation or negative correlation. And I think we're in the midst of doing the same thing right now. Maybe you could argue, all right, we already did. We had this big move up, playing catch up with the move up in the U.S. Treasury yields relative to Germany. And you can see the correlation went positive again. So maybe it's over. I don't think so. Number one, each time we've seen higher highs in this ratio, we've also seen higher highs in the dollar. We have not seen a higher high on this yet. So I think the dollar could still have some more room to move higher. And I think if you connect the lows, you'll see that we've got a really nice trend line that continues to be intact, along with the recent low around the 88.89 on the US dollar index holding. So I still think we're in an uptrend. Now, what does that mean? Well, one thing the dollar does when it's rising rapidly is it deteriorates the bottom line of corporate America, especially those multinational companies found on the S&P 500, because their foreign earnings have to be translated back using a much stronger dollar currency. And so that impacts the S&P 500 bottom line. And as a result, money rotates away from some of those companies and into small caps that do not get hurt by a rising dollar. And so you can see that while the dollar surges after those negative correlations, so does the small cap index relative to the S&P 500. Now, I think the dollar goes higher. If I'm right, I think this relative support level holds on the Russell 2000, and we make another big push up in small caps. We saw yesterday, and I don't want to use 2 days as a great sample, but so far yesterday and today, we have seen the Russell 2000 begin to outperform again, and you can see that in the little turn here as we got down to this support level. Whether or not it holds, who knows, but I do think given this relative strength support area, I think playing the small caps at this point, trading something like the IWM makes sense to me. All right, so what else can we, pay attention to with the dollar moving higher? Well, if the dollar continues in this uptrend, one thing that I've learned over the years is when the dollar is going up, Normally, commodities relative to the S&P are going down. And you can see that here. Back in 2011, when we really started to make this push higher in the dollar, notice the CRB index relative to the S&P 500 was underperforming. Notice materials relative to the S&P 500 have been underperforming. So as a trader, if I'm trying to outperform the S&P 500, when I've got a rising dollar, it's really difficult to do that with commodities, with materials, or with gold. As you can see, gold relative to the S&P 500. And that's why recently when we've been talking about gold, Erin and I both talked about the breakout and how good it looks here in the short term. Arthur Hill, when he was on with us last week, mentioned gold breaking above 115 that on the GLD would be bullish. I completely agree in the short term. But we have seen gold pop before. And if the dollar continues its uptrend, there's a long-term negative correlation between the direction of the dollar and the direction of gold. So if the dollar does continue to strengthen, I think this move on gold is going to be very short-lived, which is why I would keep a tight stop on gold if you're trading it right now. Now let's look back at the last bull market from 2002 to 2007. We had a dollar index that was falling. So this bull market is being characterized by a rising dollar. The last one was being characterized by a falling dollar. And the difference is that during the last bull market, the CRB index on a relative basis was mostly moving higher versus the S&P. The materials group was leading the bull market, outperforming the S&P 500. And of course, we know gold had that huge run up back when the dollar was struggling. So these are some of the differences that you have to be aware of. One more big difference when you look at the dollar, and that is when the dollar is falling like it was back in 2003 to 2007 in that bull market, you have to understand if you trade ETFs that track foreign stock markets, and I'm going to use the example of the German DAX and the EWG, which is the ETF that tracks Germany. Check out what happens based on the dollar. Here, the dollar is falling. The DAX during this period goes up 230% from this low to this high. The EWG goes up 370%. Now, it's designed to track the German index, but there's a dollar component in here. And the falling dollar benefits these ETFs that track foreign markets. So you can see a clear boosting of your return if you're in the EWG or if you're in any of the ETFs that are tracking these foreign markets. They actually outperformed the market they're designed to track. But what happens when the dollar is rising? Here, from 2011 to 2016, while the dollar was clearly in this uptrend, the DAX went up 50% during that period. The EWG, if you bought it here and sold it over here, you were up 10%. So the rising dollar, if it continues to rise and you're trying to trade and, if you're trying to have some kind of a balanced international portfolio and you're using these ETFs, just keep in mind that these international ETFs are hurt by the rising dollar. So there's a dollar component that you have to be aware of when you're trying to balance these ETFs. So yes, the dollar has been going down since that high back in 2017, but we have bottomed off that low in 2018, and I believe this uptrend remains intact. I think we're going to make another push to the upside in the dollar index, which is going to continue to hurt trading these international ETFs. So you want to be careful there. All right, let's take a look. I mentioned in my blog article this morning the yield spread or the curve and the fact that it is worrisome for banks. This is something that you need to be aware of from an intermarket relationship. How the Treasury markets are moving from one area of the Treasury market to another can significantly impact what's going on with the banks. So here's a chart that I put in under the current outlook. You might want to go back and review that later. But what I did is I looked at the bank index, which you look at, it's done pretty well, 16 to 18. And we've been pulling back and starting to break down. But when we look at the bank index relative to the S&P, look at what's been happening in 2018. We actually topped almost a couple years ago. We went a little bit higher here on a relative basis in the first quarter, but we're threatening a pretty significant relative breakdown on banks versus the S&P 500. And if you look at the spread, the yield spread or the yield curve, the 10-year Treasury yield is what I look at versus the 2-year Treasury yield. This is plotting, and all you do is you put into stock charts $UST 10Y minus $UST 2Y. And down here, well, let me pull up the chart and we'll go to the settings so that you can see how you can set this up in your own chart. But you can come back in this recording and look later. But this is how you can set this chart up. And so we have been seeing this 10-year Treasury yield versus the 2-year Treasury yield continuing to decline for quite some time. The most important part of this chart is to look at what happens to banks relative to the S&P 500 when the 10-year Treasury yield starts to move higher versus that 2-year Treasury yield. Here are two examples back in 2015, in the first 6 months of 2015, and in the last 6 months of 2016. And check out the relative outperformance. This isn't the bank index moving higher. I'll show you that in a second. This is the relative performance. Look how much banks outperform the S&P when we get into this rising yield curve environment, because the profits in banks quickly accelerate under those types of scenarios. But here's the actual performance in the banks during these two periods. You can see the bank index in about 9 months went from 270 to 440 in just this period where we saw a little bit of movement higher in this 10-year versus 2-year Treasury yield. So I just want to point that out and make sure everybody is aware of that. This is another intermarket area that I think is really important, especially if you're trading banks. Okay, finally, what I wanted to do is just show you the S&P 500, which has been going higher. This is just the last 5 years. But notice the correlation between the S&P 500 and the 10-year Treasury yield. So again, we're taking the equity market and we're looking at what's going on in the bond market to see if there's any kind of correlation. I think what you're going to find is that for the most part, these two they have a pretty positive correlation. In other words, when the yield is rising, the S&P 500 is generally rising with it. And the reason I want to point this out is because just a week or so ago, when we broke out on the 10-year Treasury yield above 3.11%, all the talking heads were talking about how the market is going to struggle and that we could be thrown into a bear market because of rising rates. At some point, yes, that may be the case. But we are still near record lows on Treasury yields. If our economy, if the strength in our economy can't handle a 10-year Treasury yield at 3.15%, then our economy really isn't that strong. And maybe that's the case. Maybe that'll turn out to be the case, that our economy simply wasn't strong enough. But I can tell you the history going back in the 1960s when the S&P 500 was moving higher, the 10-year Treasury yield was down close to where it is today and was rising. The S&P 500 was fine until we got up to about 6%. And so I think that 5-6% level is really what we need to be thinking about. I don't believe this move to the upside in the S&P 500 is over. And so we're going to talk about that in a second. But before we do, let's bring up a summary slide and let's talk about this intermarket analysis. Some of the things that we looked at, dollar effects, really important in the market if you're trading. I think you would agree looking at some of those charts I pulled up. Yield curve and what that can do for the banks, I think very important. And then finally, just a big picture analysis looking at the S&P 500 and the 10-year Treasury yield. There tends to be a positive correlation more than a negative correlation between those two, and I think that's important. Okay, Erin, you know, our good friend Arthur Hill, who was on the show last week, earlier today said that he believes that we are now entering bear market territory. I don't know how you feel about it. I'm not ready to make that call, but do you have any thoughts and do you want to show folks what you're thinking in terms of bear market versus bull market at this point?
Right. I think Carl did a fabulous job in Friday's weekly wrap talking about really what our position is as far as bull versus bear market and such. And really what we're watching for is the end of the cyclical bull market. So we could go into a cyclical bear market, but if we can keep this rising trend going, we'll still be in a secular bull market. So, what we have to determine now, of course, is, are we talking about a really long term? Are we going to leave the secular bull market and move into a bear market that way? I don't think so. But I do see us, moving lower. I don't think this is it. I don't think the bounce we're getting right now off of last week's pain is going to be a bear market per se. But I do see downside. I mean, you've got a lot of indicators pointing the wrong way. Of course, those big picture indicators are saying look for a bounce. But I think that's short term. I'm thinking we're looking at a correction, not or at worst a cyclical bear market.
Yeah, I'm going to say, and I'm going to pull up a chart and just kind of show you where I'm thinking at this point. First of all, you look at the S&P 500, and this has been a trend since 2009, 2010. This is on a log chart, by the way. So if you go down here and you click on this log scale, I always use a log chart because then the percentage moves are kind of in line with previous moves. So you can see the distance here between 700 and 800 is much bigger than the distance, say, between 29 and 2800, because a 100-point move now is not the same as a 100-point move back in 2009. So I think by using a log chart, it tends to kind of smooth that out. I think that we remain in a very bull market trend. I believe we're in a secular bull market, and I agree it's possible, Erin, we could be getting into like more of a cyclical bear, but I don't see enough evidence of that yet. I don't think a pullback testing a 50-week moving average. You can see back in 2015, 2016, we actually went well below the 50-week moving average, sideways consolidated for a while and then went higher. I think short term, if we do go, get weaker again, I think we could go back down to this 2,500, 2,600, really scare folks to go back and challenge that January, February low. But I'm not ready to throw in the towel here. The other thing I would say is this. We see plenty of spikes in the VIX during bull markets. It's really what happens when you strengthen on the S&P 500. Let's see what happens to the VIX. In each of the last two bear markets, we have not gone below 16 on the VIX, both of them, 2001 to 2003, 2007 to 2009. We're coming back down the VIX now. Let's see what the market does. Let's see if we break below those lows and what happens with the VIX. I just think it's too early.
Yeah. And we did have some questions in the chat room. What are you thinking about re-entry? As far as your short-term investments go, I know most of my intermediate terms investments, I'm pulling back into cash on some of them just because I don't like, I just don't like the setup right now. And I think it's just safer. I'll just turn it off for a little while. But are you still putting your money in the market right now or sitting mostly in cash?
Well, one quick chart here. Here's a daily chart. I mean, we've still got obstacles to get through here, and the falling 20-day moving average is going to be a big one. So that's something to kind of watch in the days ahead as we rally. But we are getting through 20-hour EMAs, which short term I think is good. So those are my thoughts here in the near term. I don't like the high volatility environment. So if I trade, I'm going to trade definitely fewer shares, and I'm going to try to keep my stops as tight as I can.
All right. Excellent.
Well, there we go. You can see upcoming schedule. Tomorrow is a big day. Martin Pring is joining us, so you definitely want to make sure you are here for that. I want to thank everybody for being here with us today. Please remember to complete the survey as you exit. I'm sure Erin would love to know what you thought of her workshop today. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. See you back here tomorrow. Happy trading.